In last week's episode, we walked through my overall strategy and asset allocations to set up this week, where we'll actually dive into individual positions that I hold. Now, you don't necessarily need to watch that episode to appreciate the sequel this week, although one of the things that I try to do on this channel is connect overall strategy and purpose to the actual individual investment. So, without any further delay, hit that subscribe button and join me today as I unpack the specific tickers in my portfolio right here in the red zone. Today, we'll walk through my top 11 holdings that comprise the overwhelming bulk of my portfolio. So, starting out, let's start with the growth part where I hold one ticker, and that is the Adams Diversified Equity Fund, ticker symbol ADX, with a 20% overall portfolio allocation. This is a recent change that I made as I used to hold Vanguard's VU, their S&P 500 index ETF, as the single ticker exclusively. Now, I started learning more about closed-end funds and stumbled upon an interesting tidbit here that ADX's total return outperforms the S&P 500 from a 1-year, 3-year, 5-year, 10-year, and since 1996, period. So with dividends reinvested, ADX has been growing and growing faster. The best feature of this fund is that it pays an 8% distribution of its net asset value, with 2% paid quarterly. So when I'm ready to generate income in retirement, I'll just quit reinvesting the distributions or only reinvest a smaller portion. ADX primarily holds about 100 stocks out of the S&P 500 and generates most of its distribution from long-term capital gains. Next up, in the dividend growth portion of my portfolio, I hold the Schwab US Dividend Equity ETF, ticker symbol SCHD. Like ADX, I also have 20% of my portfolio allocated to it. SCHD seeks to track the Dow Jones US Dividend 100 ETX, has a super low expense ratio of only 6 basis points, generally holds a defensive and more conservative portfolio, and after its price run up, yields about 3.3%. The best feature of SCHD is that it has grown its dividend every year since its inception and also tends to decline less than a fund like ADX in market sell offs. For longer term investors, and here I'm defining long term as greater than 20 years before you need to use dividends for income, SCHD may not be the best fund, as in the past few years, funds like DGRO are showing slightly better dividend growth with the additional upside of much better price appreciation for this general investing strategy. However, since I will need dividends to supplement my income in less than 10 years, SCHD is the better fund for me. If you're interested in dividend growth as a strategy overall, I covered several dividend growth ETFs recently in this video. Next up are the investments in my income part of my portfolio. From the real estate sector, I have two holdings. First, from Cohen and Steers, is its total return fund, ticker symbol RFI, which is currently yielding just over 8%, and I have a target portfolio allocation to that fund of 6%. I like its steady payout as well as its high quality real estate holdings as a diversifier for my portfolio. I also like the fact that, unlike many closed end funds, it doesn't use leverage, which can cause those funds to be more volatile in terms of their price. But if that's not a concern for you, you could check out RQI, which basically has pretty much the identical holdings, but just uses leverage. Also, from the real estate sector, I hold a covered call fund from Neos, ticker symbol IYRI, that writes options on real estate investment trusts. Covered call funds generally do poorly keeping up with the indexes that they track or write calls against, but the real estate sector in general has been flat for quite some time, and IYRI was beating relevant index funds from a total return standpoint since its inception. Recently, however, that has started to flip as the real estate sector is showing strong price movements in the beginning of this year, and IYRI isn't keeping up quite as well. What I like best about this fund is its yield of over 11%, And because the sector was just kind of middling, its payout has been steady since I invested in it when it was launched. As a bonus, a lot of its returns are classified as return of capital, so I hold this fund in a taxable account with a target allocation of my overall portfolio of 2%. I'm still reinvesting the distributions of this fund, but right now I've decided not to place new money here as my investing thesis for this type of covered call fund is changing with that recent and fairly rapid price improvement in the real estate sector overall. I plan to continue to hold through the end of at least the first half of 2026 to see if that general trend continues or if the price flattens out. Next up is a fund that I've categorized here in the utility sector, but it's really a global fund that is a combination of energy, utilities, and other infrastructure that, like RFI, is also from Cohen and Steers, and that is its infrastructure fund, ticker symbol UTF. In this general sector, meaning utilities, I actually like UTG a little bit better, primarily because it didn't cut its dividend during the great financial crisis, but it always trades at much higher valuations than UTF, which means its starting yield will always be less. UTF here pays me more for a similar investment with its current yield of 7%, while UTG is only yielding about 6%. I also had just started a position in UTF right during the rights offering in the fall of 2025, which during that time caused its price to decline, allowing me to get more for less. If its price stays elevated and UTG's price declines, I could switch funds, but for now, UTF is a good fund that I may hold forever with a target portfolio allocation of 6%. Next up is a midstream energy fund, ticker symbol NML, that I have a target allocation of 6% to. It currently yields just over 7% due to it also experiencing a recent price run up as the overall market rotates away from technology and into sectors like energy. The reason that I like this fund is its midstream energy companies are organized as master limited partnerships, which have high payouts, but it also has companies organized as C corporations, which tend to keep the overall net asset value of the fund improving over time. It does move around in price more than some of my other holdings, as it is sensitive to the price of oil, but when it drops, I just add more to it. Next up is a fund that holds preferred shares, ticker symbol PFFA. I like this fund a lot, primarily because its dividend of 9.25% and the fact that it's raised its dividend slightly each year over the past 6 years. Although preferred shares can be less risky than their common counterparts, I wouldn't place PFFA in that general classification as its risk is magnified by some of its lower quality holdings as well as its use of about 30% leverage. Despite those risks, I've allocated 6% of my portfolio here. Next up is a closed end credit fund from PIMCO, ticker symbol PCN, which, like PFFA, I also have a 6% target allocation to it. The best feature of this fund is that it didn't cut its dividend during the great financial crisis, nor has it cut it since. It also hasn't raised it either, but it has paid some special dividends along the way. PCN currently yields over 10.5%, and it nearly always trades at a premium, which right now that premium is just over 8%. Next up is an actively managed ETF that holds business development companies, ticker symbol PBDC. PBDC is currently yielding over 11%, but I'm expecting this fund to continue to cut its dividend in the short term if interest rates continue to move lower, which is the general market expectation. The risks here are primarily derived from the private credit market that all BDCs have a large exposure to, which is why, if you're not going to do the research on each individual business development company, which I'm not going to do, then this is the next best thing for me. The actual expense ratio is much lower than published, which, due to an accounting regulatory rule, you'll see that across BDCs, it's actually around 0.75%, but that fee is before the yield, so it's not that critical. There's also an index fund, BizD, as an alternative option, but I'm more in favor of the actively managed version as a potential mitigator against bad loans or just a poorly managed BDC. My target allocation to PBDC is 3% in my overall portfolio, and I'm currently buying this fund due to its recent decline in price. For international exposure, I like a covered call fund from Amplify, ticker symbol IDVO. What I really like about this fund is its yield of around 5%, while at the same time beating out international developed market total returns from your typical broad based funds. IDEVO currently holds about 87 companies and has a relatively conservative option strategy, as evidenced by its total return outperformance, or at least parity with your more run of the mill international funds, as well as its lower yield than you'll typically find in most covered call funds. Finally, I hold a covered call ETF with price exposure to gold, ticker symbol IGLD, which is currently yielding around 10%. As you know, gold has been on quite a run over the last year, and IGLD, as well as my portfolio, has benefited from that run. Its dividend payout historically has been low on a month to month basis, with a large dividend paid at the end of 2024 and larger at the end of 2025. But so far in 2026, it is paying a more consistent and higher dividend, which I prefer than the giant end of year payout. Because this particular investment is much more speculative in nature, I have a target allocation of only about 2%. So here's my overall portfolio with allocations and current yields. As many of you know, I want to rely as long as possible, perhaps throughout my entire retirement, on dividend payouts. So I'm interested here primarily in what my portfolio's yielding is. As you can see, overall about 6.5%, with the income portion of my portfolio yielding higher at around 8.6%. That income portion is the piece that I expect to quit reinvesting into and paying me at the start of retirement, with a fund like SCHD continuing to grow and start its payout in about 10 years after retirement. And lastly, ADX in my 70s. Although I have my favorite funds that I covered today, I also have more than my share of portfolio clutter, which sounds negative and in some cases is, but there are several other funds in my portfolio that I became interested in at one time or another and still have small positions in. To see the remaining funds in my portfolio and the actual allocations for all the funds that I hold, join me next time right here in the red zone.